All right, hi everyone. Welcome to the Commodity Spotlight webinar today, brought to you by Vantage, where the topic is going to be crude oil. We're going to take a review of Q1 review of crude oil uh, for 2025. Right, before we begin, just want to let you all know we're streaming directly to the Vantage app as well as over Zoom. So do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. Right, so before we begin, please take note of the disclaimer. The information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and/or consultation on how a client should trade. So take note of the risk warning that comes with trading margin funds and CFDs, as they carry significant risks and is not suitable for all investors. My name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between Vantage and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so here's the agenda for today, right? So basically, we're going to have a review of how crude oil performed in the first quarter of 2025. So we'll be starting off by looking at one of the fundamental drivers in the first quarter. And then after that, we'll take a look at some of the key technical levels on the charts at the present moment, right? Today being 25th of March, right? Tuesday, 25th of March, we'll see what are the key technical levels for today and identify any potential trade setups as well. And finally, we'll wrap things up by looking at potential outlook for the second quarter of 2025. Right now, starting off with the fundamental drivers for crude oil, right? There were several factors or drivers that were key to the direction of oil prices in the first quarter of 2025. First of all, we had OPEC Plus and supply decisions related coming from this cartel. So OPEC Plus, right, had delayed the unwinding of voluntary production cuts of 2.2 billion barrels per day until April, right, maintaining tighter supply conditions. Now, remember, this voluntary cut production has been this voluntary production cuts have been in place for the last, I would say, easily 8 to 10 months, right? This was a recurring theme in 2024, where OPEC Plus continued to delay the unwinding of these production cuts. And this is something that they announced at the beginning of 2025 as well, delaying this unwinding back to April of 2025. Now, when they delay the unwinding of voluntary production cuts, that means they are keeping a tighter control on supply. That means there's less supply coming into the markets. This is done to keep prices stabilized or to try and keep prices supported as well, or nudge them higher. Right. So as I mentioned, right, this decision of delaying the unwinding of the voluntary production cuts back to April is aimed at stabilizing prices and, if possible, try and nudge prices a little bit higher as well. And this is done primarily to counter any potential oversupply from non-OPEC plus producers. And this is non-OPEC plus producers basically are countries like the US, Canada, Guyana, and Brazil. Right, we are seeing because as these countries are not part of OPEC and OPEC plus, right, they are free to adjust their supply levels as per their own fiscal needs, right, and production needs. So we have seen a lot of supply coming from these non-OPEC plus members, and one of the main reasons for OPEC plus to continue to delay the unwinding of voluntary production cuts was to counter this potential oversupply. Right. Now, the next key factor from a fundamental point of view is geopolitical tensions and sanctions, right? So escalating tensions, including US sanctions on Iranian oil exports and also on Russia as well. The outgoing Biden administration, right, at the end of December, early January, imposed fresh sanctions on Russian oil exports and at the same time placed sanctions on Iranian oil exports as well. So this was these sanctions, right, that were placed at the end of December last year, early January this year, had caused crude prices to spike quite strongly in the first half of January. Right? So the first couple of weeks of January, we saw crude oil prices rally very strongly, right? Primarily due to escalating tensions as well as increased sanctions on Iranian oil exports as well as Russian oil exports. Now, there were also additional sanctions on Venezuela and conflicts in the Middle East, right, in early January, which heightened supply disruption risk, pushing prices upward by mid-Jan. Looking at another fundamental driver or factor, which is the third one in this case, is global oil demand trends, right? As you may be aware, right? Overall, global demand has remained sluggish. Global economic activity has been pretty subdued. It's showing some signs of resilience, right? But overall, uh, but as a whole, sorry, overall activity remains subdued, while demand for crude oil also remains sluggish, right? Despite global oil demand projected to rise by 1 to 1.5 billion barrels per day in 2025, right? Overall demand still remains sluggish, and this increase in demand is driven by non-OECD countries in Asia, basically India and China. Now, China has been going through a lot of structural changes over the last 2 years, and they announced they've released a range of stimulus measures since the end of last year, right, to prop up the economy, to boost industrial production, manufacturing, and services activity as well. So these stimulus measures help to provide some bullish support for oil prices initially. However, weaker than expected economic performances out of China had tempered gains as well. So combined with uh, China that's still structurally weak and slower demand uh, for crude oil at a global level, right? It has kept prices pretty much in check. Now, another factor driving oil prices in the first quarter of this year was non-OPEC plus production, right? As we mentioned earlier in a slide earlier, right? Robust production increases from non-OPEC countries, particularly the US, Brazil, Guyana, and Canada, have added approximately 1.5 million barrels per day to global supply, right? And this growth in production by non-OPEC members, right, aligned with energy policies like the US drill baby drill agenda following US President Donald Trump's inauguration in 20th Jan, have exerted significant downward pressure on prices, counteracting any potential OPEC plus cuts. Right, then we also will look at another factor, of course, which is the strength of the US dollar and macroeconomic factors, right? A weakening US dollar in the first quarter of 2025 made oil more affordable for foreign buyers, right? Supporting price increases, although this was just a marginal increase, right? However, concerns over global economic growth, exacerbated trade wars, and potential US trade tariffs under the Trump administration have introduced significant volatility and have kept any rallies throughout the first quarter of 2025. And finally, looking at inventory levels and seasonal factors, right? Global oil inventories started 2025 at historically low levels, with draws continuing into the first quarter due to seasonal demand drops and cold weather boosting heating oil. So when we see inventory levels at historically low levels and continuing and with drawdowns continuing to extend, this signals a pretty this provides a pretty good idea of the level of global demand, right? But if you see inventory levels rising sharply, whether it's global oil inventories or specifically from the US, right? If you see crude oil inventories rising quite sharply, that signals a weaker demand at a global level and also for the US. Right, there's also been efforts to refill the US strategic petroleum reserve, right, adding to some upward pressure on prices in early Jan. So combined with the sanctions, the newly imposed sanctions on Russia and Iran, and efforts to refill the US strategic petroleum reserve, we really saw crude oil prices rally strongly in the first couple of weeks of January. Now, uh, but from mid-January to mid-Feb, right? However, we saw US inventory levels as tracked by the American Petroleum Institute, otherwise known as API, and the Energy Information Administration, the EIA, right? These inventory levels rose sharply from mid-Jan to mid-Feb, which is a sign of weaker demand in the US. So if demand is weak in the US and combine that with globally slower demand, as well as subdued economic activity, and throw in trade policy uncertainties, right? It created a lot of headwinds for oil prices in the first quarter of this year. Now, just take a quick look of the summary of some of the fundamental drivers, right? So basically, these drivers reflect the tug of war between supply constraints, such as OPEC cuts and sanctions, and supply growth, particularly from non-OPEC plus countries, alongside demand uncertainties and macroeconomic influences, shaping a very volatile oil market in the first quarter of 2025. Now, looking at WTI oil, right? WTI oil began the year trading at around $71 per barrel, but it rose sharply, rallying over 12% by mid-January to reach nearly $81 per barrel. Right? Remember, at the beginning of the year, right? At the end of at the beginning of the year, there were newly imposed sanctions on Iran and Russia, right? Thus potentially limiting oil supply from these two major oil-producing countries, as well as efforts to prop up the SPR as well. So triggering a sharp increases in oil prices, with WTI oil rising sharply from $31 at the beginning of the year, rallying over 12%. Now, this benchmark reversed abruptly and sharply following President Trump's executive order to expand oil and gas production in the US. Right, this took place at his inauguration. Right, once President Donald Trump's inauguration ceremony had taken place on 20th of January, he proceeded to sign off on a bunch of executive orders, including one which was Drill Baby Drill to expand oil and gas production in the US. Now, this caused WTI oil to reverse sharply off its highs of nearly $81 per barrel by mid-Jan, diving nearly 20%, falling as low as $65.20 per barrel at the beginning of March. Now, during this sharp decline between Jan and March, of course, there were short-term spikes that had taken place, driven by geopolitical events, but these spikes or counter-trend rallies were short-lived. Now, let's take a look at key technical levels for WTI oil at the present moment, right? Based on the present daily chart, and we'll try and identify some potential trade setups. And then once we do that, we'll wrap things up by taking a look at what is the potential outlook for crude oil in the second quarter of 2025. All right, so with that, now let's move on over to the charts on TradingView. Right, so here we are on the daily time frame for the WTI chart. I've got the Ichimoku cloud overlaid in the background. Right, so we can see here. I'm just going to highlight. Okay, let me just use the vertical markers. Right, we can see the first trading day of 2025 was 2nd of Jan, Thursday, and we can see oil prices reaching nearly 79. Okay, let me go on to oil futures. Apologies, let me go to crude oil futures so we can get the correct price levels, right? As I mentioned, right? I mentioned in the slides, right? WTI oil futures hitting $80.70 per barrel by 15th of January, right? And we can see that crude oil prices have started trading or began trading the year at $71.85 per barrel, right? 2nd of Jan was the first trading day of 2025. Crude oil prices or crude oil futures, specifically WTI oil futures, open trading at about $71.85 per barrel and rallied sharply over a 2-week period, hitting $80.70 per barrel, right? This was a very sharp rally, right? And as I mentioned in the slides earlier, this rally was as much as 12.5%. Huge move in a matter of a couple of weeks. But then, right, oil prices sort of peaked by the second or third week of January, and following President Trump's inauguration, right, Monday, 20th Jan, was his swearing-in ceremony. So U.S. markets were also closed. Futures markets were also closed. Hence, after closing on Friday, 17th of Jan, the futures markets reopened on Tuesday, the 21st. Remember, 20th of Jan was the day of inauguration for U.S. President Donald Trump, and he signed off on a bunch of executive orders, including the plan to expand oil and gas production in the US that had triggered a sharp sell-off in the price of crude oil. Now, with oil and gas production expected to increase, right, and combined with non-OPEC plus high output, right, this is going to lead to a potential increase in supply, right, and that was one of the primary reasons for crude oil prices to tank and reverse sharply. Let me get rid of all of this. We don't need this for now. Right, so you can see here since its peak, crude oil has dropped nearly 19%, right, since its peak, and since the inauguration, right, crude oil prices dropped nearly 16%. So nevertheless, a huge drop, a huge reversal for WTI oil. Now, crude oil prices, right, stabilized at around $66 per barrel, right? This is a very significant support level. Right? Why is that the case? Now, when I zoom out onto the weekly time frame, we can see that this level at around $66 has been a significant support since November 2021. So over nearly 3.5 years, right? I would say maybe about 3.5 years. This level at $66.26 has been a significant support area for WTI oil futures, right? So this is how the first support has been identified. And when crude prices were falling sharply, all the way from mid-Jan till the beginning of March, as it approached this support level, this is where a lot of traders were expecting prices to stabilize, and it looks like it has made a nice floor here, right? Once again, right, you can see here over the last couple of weeks, WTI oil futures have risen quite nicely. You can see here the first significant swing low taking place in November, December of 2021. Second significant swing low bounce on the 13th of March 2023. Another bounce here on the 1st of May 2023. And then another few bounces here in September and October of 2024, all the way till December, right? And once again, we see price stabilizing, finding support, and forming a nice trough. So you can see very clearly, $66.26 per barrel is a very significant support area for WTI oil futures. Right, looking slightly below where I see the second support for crude oil futures would be at around $58.72, right? There's another swing low that was formed here, right? Nice swing low here that was formed on March of 2021, right? So this is how I'm going to identify the second support for WTI futures. Now let's come back to the daily time frame. Where is this? Oops, sorry. Let's come back to the daily time frame here. And when we zoom out, we can see right very clearly, $66.26 is a very significant multi-swing low support. That's the first support level for WTI oil. And the second support is at $58.72. Now, previously, right between mid-Jan till early March, crude oil prices were trading in a very significant downtrend, right? We had identified a very significant back downward channel. We can see WTI oil futures hitting the upper trend line of the downward channel a couple of times and hitting the bottom trend line of the downward channel several times at the end of Jan and early Feb. But since 20th of March, last Thursday, we saw a very significant bullish breakout materialize, and we've seen prices climb further, right? So we've seen prices stabilize, right? This could be a counter trend rally. Remember, after a strong um, correction, such as what we've seen, as short traders close out their positions, this can typically result in a counter trend rally or a relief rally, which pushes prices higher. Like we saw a couple of relief rallies take place at the end of Jan till mid-Feb, right? You can see here there's one over 3 strong days, right? Between 7th of Feb till the 12th of Feb, we saw 3 strong days of a counter trend rally. This is typically seen in a prolonged downtrend, right? As short traders exit some of their positions, right? Cover some of their positions, triggering a relief rally. This relief rally was as much as 4.6%, right? Pretty sharp uh, bounce or reversal in a matter of 3 trading days. And then we can see another counter trend rally taking place from 18th Feb till the 20th of Feb. Once again, a 3-day counter trend rally. And even this was as much as 3.8%. So we saw two strong counter trend rallies in March, in Feb, and we saw another strong counter trend rally at the end of Feb as well here. Now, this looks to be a much more stronger move to the upside, right? This looks to be a much more stronger move to the upside. Uh, so not only could this be a case of traders and institutions closing out their short positions, triggering a relief rally. It's also being tied up at the same time with positive news that the tariffs that are going to be imposed by the US on 2nd of April are likely to be more targeted and not going to be a wide blanket approach. So this means that we have less trade policy uncertainty, right? That means there's going to be more specific tariffs being imposed on the trading partners for the US, right? And it's not going to be a wide blanket, which should improve overall market sentiment and also create less trade policy uncertainty. And that is all quite likely going to keep will help to alleviate some of the pressures faced on the economic output front, right? So if we do see a targeted response by the US with regards to tariff implementation, right, that's going to remove a lot of the trade policy uncertainty from the markets, and that is going to help improve sentiment for crude oil as well, right? With economies looking to uh, expand uh, better, right? Expand much more better without significant trade tariffs, right? Remember, trade tariffs are very likely going to create a lot of headwinds for global economies. And if the approach is more targeted, right, if the approach by the US is more targeted with regards to implementing these tariffs, that's likely going to uh, create less headwinds for economic output and help spur demand for crude oil. So it's a combination. I feel it's a combination of relief rally, counter trend relief rally, short traders and institutions closing out their positions, triggering a short covering rally, and combined with a much more targeted approach by the US with regards to the implementation of trade tariffs that has pushed crude oil prices higher. So we're probably looking at improved sentiment and improve outlook for economic activity, global economic activity as well. Right, so we're not completely out of the woods just yet, right? But this is a good, this bullish breakout here, right? That triggered a lot more buyers for crude oil, as well as uh, the targeted response by the US with regards to the implementation of trade tariffs has also removed a lot of trade policy uncertainty, which in turn will help overall global economic output and in turn should keep uh, global demand for crude oil, uh, supported as well. Now, as prices are rising strongly, right, where could be the first resistance, right? As we've seen as we've seen here, right? There was a swing high resistance here that had taken place on Feb at the end of Feb here. Pretty significant swing high resistance here. This is where we can probably identify the first resistance. And this is where also for anyone who's long on crude oil futures, right, WTI oil futures, this is where you can identify your first take profit target, right? At around $70 per barrel would be a suitable area to identify any your first take profit target for any long positions that you may have for WTI crude oil futures. Now, higher up, I see another swing high resistance that had taken place here. That's on 21st of Feb, and that level sits at $72.58 per barrel. This is where I will identify the second resistance here. Now that we've identified the resistances, I'm also going to run a Fibonacci retracement on this prolonged downtrend. Starting from this swing high on 15th of Jan, going down to the swing low on the 5th of March, looking at all the Fib levels, we can see that crude oil futures, right? WTI oil futures have already climbed above the retracement at 23.6%, so this level is no longer valid. And 38.2% is sort of sitting in no man's land, so that's fine. But we can see 50%, the 50% retracement sitting pretty close to the second resistance. So we're going to keep the 50% retracement on the charts in our analysis and remove all the other retracement levels. Now, so as I mentioned, you see the nice bullish breakout materialize for crude oil on 20th of March. Prices have risen strongly since the bottom here, right, from this trough on 5th of March till today's high, right? WTI oil futures have rallied over 6.5%. Right, and this looks to be gaining further traction. So anyone who's long on crude oil, WTI crude oil futures, identifying your first take profit target at around $70.30 per barrel would be a suitable area to do so. And of course, should this commodity continue to climb higher, right, we can then target the $72.50 mark as as another potential take profit target. Right. Okay. Looking at Please, I don't need. Let me look at RSI. Right? We're going to look at some momentum indicators as well. We're going to look at the relative strength index, and we'll also take a look at where's the one. Okay. And we're also going to take a look at the stochastic oscillator. Right, for the stochastic oscillator, we're going to use the parameters of 20 for the length and 3 for the each of the smoothing parameters. For RSI, we'll use the period of 14. And I want to also take a look at the moving average as well. There we go. So the yellow line is the moving average of the RSI line as well. Right. So we can see here, right? What I want to highlight here with these momentum indicators is that on 5th of March, right, we saw oversold condition being highlighted by the RSI and the stochastic oscillator, right, RSI dropping as low as 32 and stochastic oscillator dropping under 20, right? It highlighted uh, uh, a potential oversold condition, and this is pretty much bottom ticked the uh, the fall in crude oil prices since then, right? Since 5th of March, we saw crude oil prices stabilize around $66.40 per barrel, right? Stabilizing here for about a period of 10 trading days or so before finally breaking higher on 20th of March and triggering a very strong counter trend rally here. So it's also important to take note of momentum indicators, right, such as the RSI and the stochastic oscillator, because when both of them line up and highlight an oversold condition such as this, right? When we see an oversold condition being highlighted, such as this, with RSI dropping to 30, or in some cases even dropping below the threshold of 30, while the stochastic oscillator drops below 20, this indicates a potential oversold condition, and that means quite likely prices could stabilize and reverse to climb higher. Remember, we're on the daily time frame, so an oversold condition like this holds usually holds a lot of weight. Similarly, when the RSI climbs over 70, and the stochastic oscillator also climbs above 80 or 90, it indicates an overbought, a potential overbought condition. And typically, we can expect prices to stall, especially on the daily time frame. So we saw an oversold condition being highlighted here on 13th of Jan, right? And we see another one being highlighted on the 15th of Jan. It was only after the 15th of Jan, right, after the second overbought condition was highlighted, right, we saw crude prices finally reverse. So you could see here the momentum indicators, right, the RSI and the stochastic oscillator, right, both of which remember beyond the daily time frame had highlighted a potential overbought condition, telling us this rally in crude oil prices is likely to stall soon. And we did see, not only did we see price stall after 15th of Jan, we actually saw a quick and abrupt bearish reversal, leading to a drop that was as deep as 20%. Right, so it's also important to pay attention to momentum indicators such as the RSI and the stochastic oscillator on the daily time frames, because when they highlight a potential overbought condition, such as the one seen on 13th and 15th of Jan, and an oversold condition as seen on 5th of March, it typically tells us, yes, price is about to potentially make a reversal. Now, this can be a bearish reversal in the case of an overbought condition, or a bullish reversal in the case of uh, an oversold condition. Yeah, bullish reversal in the case of an oversold condition. So take note as well. So as of now, right, as of now at the present moment, RSI is around 50, it's in the neutral zone. Stochastic oscillators just above 50 as well, sort of in the neutral zone as well. Neither of these momentum indicators are highlighting an overbought condition. And of course, they're clearly not highlighting an oversold condition as well. So quite likely, right, based on these momentum indicators, this rally in WTI futures still has some room to run. And you can identify your first take profit target at the first resistance. It's a swing high resistance that had taken place at the end of Feb. And that level sits around $70.35 per barrel. And of course, if you see this commodity or this benchmark rather continuing to climb higher, we can target the second resistance, which is another swing high that has taken place on the 20th of Feb, and it's also accompanied by a Fibonacci retracement at 50%. This is where we can identify a second take profit target for crude oil futures. All right, okay, so these are the key technical levels here, right? And as of now, right, the momentum for crude oil is to the upside, right? So I think this is pretty good take profit targets to identify for any long trade that you may have for WTI oil. Now looking over at the 4 hour time frame, right, and combine it with the stochastic and RSI, right, it does seem like we are approaching an overbought condition on the 4 hour time frame, right? It does look like we are approaching that level soon. So perhaps uh, where we have identified the first resistance is going to be a pretty good area to at least try and bank some profits on any long positions that you may have for WTI oil. All right, okay. Now with that, these are some of the key technical levels that we have identified on the daily time frame, as well as what is the current setup here, right? There's definitely I'm not going to be shorting oil, crude oil at the present moment. If you've been long on oil as of last week, or perhaps from the beginning of this week, right, where I would recommend to identify your first take profit target is once again at the first resistance, which is at around $70.35 per barrel. Remember here, this is for the daily time frame for WTI crude oil futures. Right, now let's return to the slides and look at what is the outlook for crude oil in the second quarter of 2025. All right, once again, we're going to look at the outlook from the perspective of OPEC plus supply policies, uh, global demand, um, production outputs, as well as macroeconomic fundamentals and the strength of the US dollar. So starting off with OPEC plus supply policy, right? Once again, OPEC Plus has delayed unwinding its voluntary production cuts of 2.2 million barrels per day until April, and a gradual phase out is likely to begin over the next 18 months from April, right? Unless they delay this voluntary cuts once again, right? Right, they delay the unwinding once again in April, right? If they don't do that, it's very likely going to see an increase in supply, right, over the next 18 months beginning in April. Right, so from the second quarter between April and June, this would translate to an initial increase of approximately 138,000 barrels per day in April and about 122,000 barrels per day in May, with further increments to follow. Now, however, right, persistent overproduction by some members within OPEC Plus, such as Kazakhstan, could add complexity, potentially increase supply beyond targets by 680,000 barrels per day or more. And this does not include any overproduction capacity by non-OPEC members as well, right? Particularly the US, right? Especially with their uh, latest executive order to expand oil and gas production in the US, while other non-OPEC countries such as Brazil, Canada, and Guyana could also keep their respective production levels elevated. Now, this gradual supply hike aims to balance out the market but risks creating a surplus if demand falters, and which would naturally exert further downward pressure on prices. Now, looking at non-OPEC plus production growth, right? This is, as I mentioned just now, right, led by the US, Brazil, Guyana, and Canada. Their total supply is expected to rise by 1.5 million barrels per day in 2025 to reach 54.6 million barrels per day, right? Especially under the drill baby drill policy, right, which continues to drive output or production output in the US, specifically the Permian basic growth, right? This has led to a production forecast of 13.7 million barrels per day by 2026. Right, so any robust growth in production output by non-OPEC plus members, right, is very likely going to offset any potential OPEC plus cuts. Right, so this is going to contribute to a well-supplied market and capping price on crude oil unless significant disruptions occur due to any heightened geopolitical tensions. Right, looking at demand, right, global oil demand is once again projected to remain more modest, right, and non-OECD countries from Asia, specifically China and India, will be driving 60% of this growth. However, right, take note, China still remains is still facing structural headwinds, and being the world's previously being the world's largest importer of oil, I believe right now they're still the world's largest importer of oil, but their imports have dropped significantly as well. Weak economic activity in advanced economies, and of course, the ongoing shift to cleaner energy sources are also tempering demand, So this is definitely going to limit any bullish pressure on prices, right? Absent a strong economic rebound and or combined with any potential geopolitical escalation. Right? Looking at macroeconomic conditions and US policy, right? A weakening US dollar, which is what we've seen recently, right? We've seen the dollar index reverse very sharply from mid-January all the way till early March, right? A weaker dollar could also support oil prices, right, by making crude prices more affordable globally. But macroeconomic headwinds continue to loom large, right? The Trump's administration trade policies, including potential tariffs on its key trading partners such as Canada, Mexico, and China, which are expected to begin in April 2025, is going to certainly introduce a lot of uncertainty. However, the latest news as we saw yesterday, Monday, 24th of March, was that these trade tariffs are likely to be more targeted and they won't be a wide blanket implementation. Right, so any aggressive tariffs are definitely going to dampen global economic growth, which in turn is going to reduce global oil demand as well. And also, President Trump has also stated a goal of pushing oil prices towards $50 per barrel, right, to align with increased production, right, and pressure on OPEC Plus to maintain market share as well. So all of this is going to combine and create a bearish tilt for crude oil prices. And looking at geopolitical risks and any further sanctions, right, tighter U.S. sanctions on Iran and also potential renewed pressure on Venezuela as well, right, could reduce oil supply up to 1.5 million barrels per day. However, like as I mentioned, any further escalations, not only in the Middle East, but between Russia and Ukraine as well, could add further risk. Right now, there's some hope of peace talks commencing between Russia and Ukraine, right? There's some hopes of a ceasefire between these two countries. However, should these ceasefire talks fail, uh, and if unfortunately war continues to escalate in this region, as well as in the Middle East, right, this could stoke oil prices higher, right? So all of these factors could, while these factors could tighten supply, right, sanctions are going to tighten supply, while middle geopolitical tensions could add further risk. This could support prices in the second quarter of this year. However, the impact overall is expected to remain uncertain, right, as operators adapt to the shadow fleet as well, right? There's a lot of things going on in the background with regards to supply and shipping here that could that could enable Iranian oil, for example, to continue to come into the market. And also looking at inventory dynamics, right? Global oil inventories are expected to draw down through mid-2025 due to seasonal factors and OPEC plus restraint. However, second quarter is likely to see tighter balances, and we could see drawdown start to taper off much more significantly or notably, especially if global economic output or global economic activity starts to reduce or starts to slow down even more, right? And especially if OPEC Plus unwinds proceeds as planned and non-OPEC Plus growth continues to persist, right? Inventory levels are expected to build, right? They'll definitely stabilize and would definitely build by the end of second quarter of 2022, easing any price pressures. Right, so the conclusion for the outlook of 2022 is, right, crude oil outlook leans on the bearish side, right, but within a manageable range, with WTI oil likely averaging between $67 and $72 per barrel. Right, OPEC plus unwinding, right, will definitely be offset by non-OPEC plus growth. Remember, particularly Canada, either the US, Canada, Guyana, and Brazil. And demand continues to remain a wild card as well amidst all the macroeconomic uncertainties, which includes the trade policy uncertainties. Geopolitical risks provide potential upside, but the market appears poised for stability, right, especially with a potential ceasefire being broken between Russia and Ukraine. Traders should also, and what can should traders watch out for as we uh, move into the second quarter, right? As we wrap up the first quarter of this year and move into the second, traders should watch out for OPEC plus compliance, any potential unwinding of uh, production cuts or delayed plans to unwind these production cuts, as well as a more targeted response to tariff implementations, and also monitor China's economic data as well. China, remember, continues to remain in structural headwinds, continues to face structural headwinds, And if we see significant and notable improvements in their economy, that's likely going to uh, help oil prices remain elevated. All right. So before we move back to the charts and trading view, right, for those of you who are on Zoom, I'm just going to launch a poll as well. Truly appreciate it if you guys can give your feedback with regards to today's webinar. And then we'll switch on back over to the charts and trading view and wrap up the session with some key levels for oil once again. Right. Can keep the poll running for a little bit longer. Good to see all the responses coming in. I truly appreciate this. All right. I think there's most of you who have voted. All right. All right. Great. Excellent. Right, then let's continue by returning to the charts and trading view. Once again, to CL1 apostrophe is the ticker symbol for WTI crude oil futures here. And we can see even today, crude oil prices are rallying strongly. Right, oil prices have rallied almost 7% since its lows on 5th of March. Right, it's a very strong rally. We saw a bullish breakout materialize here. And we saw a bullish breakout materialize on Thursday, 20th of March last week. And that bullish momentum has continued, especially at the beginning of this week. Right. So anyone who's been long on WTI oil futures as of last week, or perhaps at the beginning of this week as well, identifying your first take profit target at around the first resistance at $70.35 would be a suitable area to do so. Right. This is a swing high resistance that was formed on 27th of Feb. And of course, should we see crude prices continue to stem even higher, right, we can then target the second resistance, which is another swing high resistance that was formed on 20th of Feb. And it's also accompanied by Fibonacci retracement at 50%. And we can identify another take profit target at around $72.58. And remember, as of now, on the daily time frame, the RSI, right? The RSI stochastic oscillators are momentum indicators. Right now, they're both exhibiting a neutral outlook, right? Neither of them are showing an overbought condition or oversold condition, right? Remember, oversold conditions is what is highlighted here, right? When the RSI drops to 30 or below 30, while the stochastic oscillator drops under 20, this when both of them line up together like this, at the lower thresholds and the respective lower thresholds on the daily time frame, it highlights a potential oversold condition. That means very likely prices are likely to stabilize, consolidate, and perhaps even form a nice bullish reversal. And that's what exactly has played out. Prices stabilized around $66.30 per barrel since the 7th of March before finally breaking higher on the 20th of March. Similarly, right, when both of these indicators reach their upper thresholds, right, with RSI climbing above 70 and beyond, and the stochastic oscillator climbing beyond 80 or even as high as 90, this would signal potential overbought condition as what was seen on 13th and 15th of Jan. Right, these two red vertical lines are potential overbought conditions, and we did see finally crude oil prices stall on Wednesday, 15th of Jan, before making a sharp reversal on Thursday, 16th of Jan, and the downside accelerated following uh, the announcement of the executive order to expand oil and gas production in the US. Right, so you can see here on the daily time frame how potential overbought and oversold conditions, right, can help us identify potential turning points as well, especially on the daily time frame, right? Especially on the daily time frame when the stochastic, when RSI and stochastic oscillator hit their upper threshold, that's likely to signal a potential overbought condition. And similarly, when they hit their lower thresholds, they're likely to signal an oversold condition. All right, and looking at the 4 hour time frame, looking at the 4 hour time frame for WTI oil futures, right, we can see here RSI is starting to climb into the 70 region, while stochastic is at 90. right? Not really indicating a very clear overbought condition just yet, right? Perhaps something like this here that we see here in middle of January, we can see RSI hitting about 76 on the 4-hour time frame, while the stochastic oscillator hitting around 91. Perhaps that's where we can expect a potential oversold condition, overbought condition to be triggered as well, right? As of now, right, you can see RSI is about 70 on the 4-hour time frame, and we can see here the last time the oversold, overbought condition was highlighted on the 4-hour time frame was when RSI hit about 77, and stochastic oscillator was also around 95. We're not there just yet. Perhaps you will see that when crude oil futures, WTI futures, come close to the first resistance, which is around $70.35 per barrel. Right, so these are the key levels here for WTI crude oil futures on the daily time frame. And also take note of the momentum indicators, RSI and the stochastic oscillator. They really do help us identify high probability overbought conditions and oversold conditions on the daily time frame. All right, that's all I've got for you guys today. Right, once again, thanks everyone for tuning in to today's session brought to you by Vantage. Do look out for all upcoming webinars for the remainder of this week. All right, I wish you all the best in your trading journey and looking forward to seeing all of you at the next session. All right, thanks everyone. Take care and have a great trading week.